What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Wednesday, everybody. The outbreak situation both in Shanghai and across the country continues to worsen by the day. This morning, Tuesday morning, officially recognized new daily cases reached over 8,500, a new record for the country. As we know, Shanghai is in partial lockdown with Pudong under lockdown and Puxi to join them in a few days. Some commentators have expressed surprise by the poor rollout of measures in Shanghai, typically viewed as having a Singapore-like level of bureaucratic competency. Washington-based veteran China analyst Bill Bishop, for example, expressed today, quote, "Shanghai officials seem to have been surprised by how quickly Omicron went out of control in the city. Given their usually high level of bureaucratic competence, that is worrisome. It is also a bit surprising to see that officials, who spend lots of time studying some topics like Xi Jinping thought, do not seem to have spent a lot of time learning the lessons from other cities. And so we are again seeing some issues around food provision and access to medical care, this time in Shanghai." End quote. In Pudong, which is already under lockdown, many residents are having trouble ensuring a steady supply of groceries from resource-stretched delivery services. Vegetable prices tripled on Tuesday, causing panic buying in the area west of the river. Domestically, state media is choosing to focus on the resources mobilized and play down the shortages, writing yesterday that a total of 19 makeshift hospitals have been built in Jilin, the province to the northeast, also dealing with its own serious outbreak, and that Shanghai has converted the over 150,000 square meter Shanghai World Expo Exhibition Center and Convention Center into an isolation venue that can accommodate about 7,000 people. However, if the spread is not controlled, Shanghai alone could see that many people in need of isolation every day. One Hong Kong-based infectious disease expert speaking to the South China Morning Post today said the lockdown and mass testing would aim to find areas with cases, and if so, he expected more targeted controls to be imposed, pointing out that in Shenzhen, just across the border from Hong Kong, after citywide lockdowns ended, restrictions were kept in place in areas of the city where infections were found. Quote, "After testing, places with no cases can relax their controls. Areas with cases might continue to be locked down for 1 to 2 incubation periods of the virus, which last 7 to 10 days. These areas will be able to lift restrictions when they get back to 0 cases." End quote. Many have asked me about the vaccination rates in China. Like the situation in Hong Kong, which we explored last month, in the mainland it's not promising. According to a University of Hong Kong study, more than 130 million Chinese aged 60 and above are either unvaccinated or have received fewer than 3 doses. On top of this, China's domestically produced Sinovac vaccine, which the vast majority of the mainland population has received, those who have received the vaccine have received, is found to be less effective at preventing death from COVID among the elderly than other vaccines. Of course, we understand too, outbreaks cause economic damage, just as we've seen in other countries, but with China's zero-tolerance policy still in place, restrictions are extra disruptive, and thus the economic cost is often higher. Bloomberg News writes today about this cost, quote, "China's COVID lockdowns are likely costing the country at least $46 billion a month, or 3.1% of GDP, in lost economic output. And the impact could double if more cities tighten measures." That's a minimum estimate from an economist at the Chinese University of Hong Kong, based on the assumption that cities generating about 20% of China's gross domestic product are currently imposing targeted lockdowns. That cost would double if those areas had to follow Shanghai and impose stricter policies requiring more residents to remain at home. End quote. But this could also end up being a conservative estimate. One economist at ANZ suspects Shanghai may have to keep its restrictive measures in place until early May. Capital Economics has written this week too that disruptions caused by the current Omicron wave are already set to eclipse the Delta variant-induced lockdowns that swept China last year. We remember that China set the high target of 5.5% growth this year, If these lockdowns combined with everything else end up pulling down growth this quarter, it means that Beijing will be forced to turn once again to huge amounts of debt to reach that growth target, much in the way that it did back in 2020. Hey guys, as always, if you're enjoying the content, please hit that like button. It's a massive help for a small channel like this. If you're watching for the first time and you're getting some value from this analysis, from this sort of content, maybe consider subscribing, hit that bell notification, and you'll have the most up-to-date analysis when these are released every day. Okay, next up, the US and China continue negotiations to come to a solution on an audit dispute, which, if unresolved, would result in Chinese companies being kicked off US exchanges. Some companies have already been identified as problematic by the Securities Exchange Commission, an announcement which caused a devastating sell-off of Chinese ADRs 2 weeks ago. ADRs, of course, American Depository Receipts. These are instruments by which investors on US exchanges can invest in companies that do most of their business in China, as well as other foreign countries. We remember that this massive sell-off did not rebound until Vice Premier Liu He, in an emergency meeting a few days after, announced that Beijing would stabilize capital markets and work with US regulators to keep Chinese companies on US exchanges. Now, this is easier said than done, though. For years, Chinese companies were given auditing exemptions not available to US companies or many other international companies. US regulators sort of looked the other way. But in recent years, as the political environment between the US and China has become much more adversarial, US regulators have applied more scrutiny to Chinese companies. Quote, "The PCAOB's requirements are straightforward, including the ability to inspect or investigate completely any audit engagement within our mandate, regardless of the issuer's location or industry. This requires full access to audit work papers, firm personnel, and any other relevant information related to such audit engagements." End quote. One senior partner of law firm Beijing Denton's law offices, speaking to Chinese financial media this week, very accurately puts this deadlock in a nutshell. Quote, "China is unlikely to consider giving US regulators unrestricted access to work papers, and the US doesn't appear like it is going to tolerate this anymore." End quote. Interestingly, state media sounds more optimistic that a deal will be reached than US media, with state-run China Securities Journal expressing on Monday, quote, "Both Chinese and US regulators are fully aware of each other's concerns and are moving toward each other and working hard to find solutions to the issue in order to achieve effective and sustainable cooperation as soon as possible." End quote. Maybe this is to calm markets, maybe they know something we don't and there is reason to be optimistic, or maybe it's just uninformed wishful thinking. We will find out over the coming weeks. And last up, the Evergrande Housing Crisis, and we have new data from March. We have fresh data from the housing sector this week, and things are looking even worse than before, with only some silver linings. According to data from China-based property think tank China Index Academy, published on Monday, in the month of March, up until the date of publication, sales in key large and mid-sized cities dropped by nearly half year on year, and the risk of default has increased for more developers. The report says that housing sales by floor space fell 49.1% year on year in March in 17 Chinese cities that are surveyed. This is a much deeper contraction than the 23.4% drop in February, which was already quite bad. China Index Academy says that the cities tracked include, quote, "larger, more developed first-tier cities, as well as second- and third-tier cities," end quote. That's the bad news. The lukewarm news is that March sales were up 21% month on month from a low base after the sector saw a 31.3% month-on-month contraction in February, which itself was down from a 21.8% decline in January. However, when we look into the data, we see that this modest rebound in March is driven by sales stabilization in first-tier and second-tier cities, while third-tier cities still report sale declines. This is concerning as, like we've discussed before, it is in the lower-tier cities many of which are not included in this data, where the industry is most bloated, the most over-leveraged, and the most vulnerable. Tomorrow we will have more on the housing crisis, including the mass resignation of accounting firms previously representing some of the biggest and most important Chinese developers. See you tomorrow. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.